Good morning, folks. My name is Chris Chandler, president of PFL. We hope that everyone had a great weekend. The Dow closed higher on Friday of last week and was up 153.3 points and up 106.32 points week over week. The S&P 500 closed higher on Friday of last week, up 22.9 points and up 79.94 points week over week. The Nasdaq closed lower on Friday of last week, down 22.54 points, but up 275.46 points week over week. And overnight trading, Dow futures traded higher and are expected to open up this morning 2 points. Folks, what a ride last week. Crude oil prices rose more than 1% on Friday of last week as traders reconciled the impact of a missile attack on the oil distribution facility in Saudi Arabia with a possible release of U.S. Petroleum reserves. WTI closed up $1.56 to settle at $113.90 per barrel. Yemen's Hafti grew to credit for the attack at the Saudi Aramco site with missiles. Yemen exposed the volatility of the country's crude supply. U.S. commercial inventories closed down 2.5 million barrels week over week and are 13% below the 5-year average for this time of year. Total motor gasoline inventories decreased by 2.9 million barrels week over week and are at the 5-year average for this time of year. Distillate fuel inventories decreased by 2.1 million barrels week over week and are 17% below the 5-year average for this time of year. Propane and propylene inventories increased by 300,000 barrels week over week and are 23% below the 5-year average for this time of year. Propane prices fell sharply last week as weather improved and demand for prompt propane saw some relief. Propane prices fell 32 cents per barrel or per gallon week over week to close at $1.30 per gallon, up 39 cents per gallon year over year. Oil is lower in overnight trading and WTI is poised to open down $4.21 a barrel from Friday's close. Total North American rail volumes were down 3.5% year over year in week 11, resulting in quarter-to-date volumes that are down 4% year over year. 7 of 11 major AAR traffic categories posted year-over-year declines, with the largest decreases coming from intermodal down 6%, and grain was down 18.7%. The largest increase came from coal, which was up 8.4%. North American rig count is down by 29 rigs week over week. U.S. rig count was up by 7 rigs week over week and up by 253 rigs year over year. The U.S. currently has 670 active rigs. Canada's rig count was down by 36 rigs week over week and up by 59 rigs year over year, and Canada's overall rig count is 140 active rigs. Overall, we are up 312 rigs collectively. Folks, we are watching commodities. As I'm sure all of you know, President Biden was running around Europe this past week and weekend touting that the U.S. is going to come to the rescue, provide natural gas to Europe, and wean Europe off of Russian oil. If true policies are going to change here at home, and that would be great news for the rail industry, the U.S. economy, and the consumer alike. In today's report, we are going to take a look at crude by rail, nat gas, and LNG. Crude and crude by rail. Folks, we at PFL have had a number of conversations with a lot of people in the industry last week who have tank cars looking to lease out and have been asking, what happened to crude by rail? When is it coming back? Why is it not back right now when oil is so high and we have supply disruptions and are in the middle of a war? These are very good questions, and we try to answer them the best we can in today's rail report. We dive into current crude by rail numbers out of Canada, inventory levels, and dive into tank car fundamentals. Please read today's report. You won't be disappointed. Bottom line, Crude by rail out of Canada comes down to pipeline capacity, production, and governmental policies. Natural gas. Folks, the more natural gas we produce, the more natural gas liquids we produce. NGLs include natural gasoline, propane, and butane, and has a positive effect for rail industry for obvious reasons. The more rail traffic. Of course, the more natural gas we produce, the more LNG we can export. I know this is all basic stuff, what we are saying, but why are we saying we can bail out Europe? We are currently at capacity as far as LNG we can export. We are short propane here in the United States and are 50% higher in price than we were this time last year. Working gas is 1,380 BCF, which is 366 BCF less than last year at this time, and 293 BCF below the 5-year average. We have the solution. See PFL's rail report today, a must read. The reading of PFL's rail report today is an absolute must. We not only dive into more detail as discussed in today's podcast, we also summarize the latest petroleum by rail numbers, talk about refinery runs, overall petroleum import and export numbers, and dive into the latest U.S. employment situation. Bottom line, a lot of great information, a lot of fancy graphs, and a couple of maps. Everyone loves maps. We know that you will enjoy reading PFL's rail report today, and we certainly do it all for you. PFL has been extremely active in railcar storage, return on lease strategies, subleasing, mobile repair, flaring, and cleaning. Make sure to check out our just posted reports at pflpetroleum.com or call PFL to troubleshoot or any questions or concerns you have. Our number is 239-390-2885. Have a great week, folks, and thanks for listening.